Okay, I want to say thank you for joining us today. My name is Isaiah. I'm the Development Director with the Michigan Cannabis Industry. And I want to thank Tatiana Grant and Maddie Henry from Manor Costa Region and Shantoya for joining us today. Our topic is cannabis accounting. And our speaker, Madeline, will be taking it over. And we encourage you guys to please leave your comments or questions in the comment section, and then we'll be answering them towards the end. And thank you, Maddie.
Sure, no problem. Thanks, Isaiah. All right, let me go ahead and try to share my screen here. I think that worked. All right, awesome. Yeah, as Isaiah mentioned, definitely feel free to chat in any questions. And, I'm just going to go through some slides right now, and then we can address any open questions at the end. Just a little bit about myself. My name is Maddie Henry. I'm a CPA. I've been working at Maynard Custerson public accounting firm for about 10 years, which feels a little scary to say. So that's been a while, but for cannabis specific entities, I've been involved in for about the last 3 years. So I'm excited to talk to you all today and hopefully give you some information that'll be helpful to you. Let me go ahead and click over here. So a little bit about our firm and just some of the things we do in case it's helpful. Our firm has been involved in cannabis specifically for about 5 years now. And we tend to go to different expos and stuff like that. And members of the MICAA, which is an awesome organization, definitely. Some of the things that we help with specifically would be technology services for like really robust software like Intact, entity structuring. So that's something definitely we'll talk about today. Some considerations, things like that. Various tax consulting. So that would be like lease analysis or floor plan analysis for 280E allocation stuff, very specific to cannabis that can definitely help you. We also can do the traditional things like attestation, tax returns, typical things you might see there. Accounting is an important one. Definitely not the most exciting topic, but definitely can save you some headaches if you get the right help on the front end. And something newer that we can help with as well is wealth management services. So our firm can help with specific 401k plans for cannabis entities. So that can be a great retention tool for talent and stuff, especially because it can be so competitive to find really good employees and reward them and keep them happy. So the first part of the things we'll talk about today, common entity structure considerations. It's very common practice for us to see that entities start out as an LLC. Typically, the first call that somebody that might be starting out in this industry might make would be to an attorney, get their entity set up, get an EIN, all of that. And the reason that attorneys tend to default to an LLC would just be because it's just inherently flexible. So there are a lot of things you can do once you get a little more information and decide what your long-term goals are. Some things you might want to think about when you're picking your entity structure would be about limiting your liability. Some entities are a little bit better at that than others. Once your entity is up and running, you're making a lot of money, how do you get cash out? Can you write yourself a check? Those types of things. That varies by entity. Sometimes too, when people start out in this industry, they may have like one person they're working with, but they need more of a capital investment. So if they're looking at bringing somebody on board that wants equity, there are some entities that are better suited for that as well. Of course, the tax rates are different depending on how your entity structure is, and as well as whether it's subject to self-employment. So let's go over some of the common ones here. So starting off with probably the most simple one, a single member LLC. As the name suggests, there can only be one owner. And how this is reported to the IRS would be on your personal tax return. So your 1040 that you file annually. That's due in April in a normal year. Last couple of years have not been normal, but it's reported on a form Schedule C. And so there's no separate business tax return filing. It's all under one umbrella, so to speak. And so that can be nice in terms of like simplifying things, like it's all under one filing, but well, you know, if you're looking at pros and cons, that might be considered a pro. You're not technically supposed to issue a wage to yourself as an owner if you're a Schedule C. So that can be like if you plan to work at your entity, issue yourself a paycheck, every couple of weeks. You're not supposed to do that with this entity structure. So because it's reported under your personal return, you are taxed on your net income depending on whatever bracket you might fall under. So for an individual, that totally depends on what you make. So you may have if you're married filing jointly, you may have a spouse that's a high earner or, other things involved. So depending on how profitable your business is, you may be at some of your income may be taxed at the highest federal rate, which is 37%. And that's just federal. Then of course there's the Michigan tax too. And that is 4.25%. So, it definitely eats into your net profits. And then as a Schedule C, in addition to all of that, there's also a self-employment tax. So if you're making a net profit, you may also have to pay that tax. So, those are some downsides, I guess you might call it, to having it structured this way. Some best practices, when something's all like under your personal umbrella, you're reporting everything together. We definitely would recommend having a separate bank account for your business. It's easy to kind of run everything through your own checking, but the problem with that, as we'll talk about later, is it really muddies things up for your AUP reporting for the MRA. If there's ever to be an audit, it just makes things super messy. So that's something that if you can keep a separate bank account for the business, that would be great. And there are some credit unions specifically that are in the cannabis space. So there are definitely some options there. So since you can't pay yourself a W-2, what are your options? You could pay yourself by taking out a tax-free distribution. So you could write yourself a check from the business bank account, but just like a little, disclosure or whatever, you can only do that to the extent of your basis. And we don't really need to go into all of that means at this time, but if you've got specific questions on that, we can definitely talk about that later. So you write yourself a check and then you can use that money however you'd like, whether that be to pay the tax you owe at your 1040 level, or, to buy a boat or whatever, you've got a lot of flexibility there. So that would definitely also be considered a pro of having this entity structure. Downside is if you were to be audited by the IRS or state of Michigan, your entire personal return is going to be subject to the examination, in that if you owe a lot of money, your business does really, really well, you don't have the cash to pay the tax, that tax follows you as an individual around. So that's a downside, I guess, to consider. The next kind of bracket or whatever would be pass-through entities. So those would be S corporations or partnerships. The plus side is they can have multiple owners. So that's great, especially if you're working with a partner or somebody else that's really involved in the business. So you can each have an ownership share of the entity. So this is different from a single member LLC because you are actually filing a separate business return. So that will report all the income, deductions, everything for the business, but the tax is not paid at the entity level. So you file your business return and then it's almost informational in a way because it would just tell you your share of the income and deductions to be reported on your personal return. So there's more separation than there was with a single member LLC. But the business returns kick off, it's called a Form K-1, which is a summary of your ownership share. And you would again report that on your personal return. And similar to the single member LLC, you're going to pay tax depending on whatever bracket you land in terms of taxable income. So that could be up to the highest rate of 37%, if you're bumped into that bracket for that portion of your income. Some differences. An S corporation is not subject to self-employment tax. The partnership potentially could be if you as an owner are actively involved. So you would, show that portion of income being subject to self-employment tax. So there's arguably more separation from the entity from a legal / audit perspective by having your entity as a S corp or pass through. So that's a bonus, if you're looking for like liability limiting attributes. But the S corp must issue a reasonable wage to any owner that's actively involved. So, reasonable wage, that's a whole other topic, what's considered reasonable. But just keep in mind that if you are as an S corp, structured as an S corp, and you do want to, be actively involved, you would need to pay yourself a wage. Another plus side of the pass-through entity structure would be that both entities allow tax-free distributions, again, to the extent of basis. So similar type of thing where you as a partner or shareholder can write yourself a check, but an S corp has some special rules about how those distributions have to be equal among the shareholders. So it's a little bit of a breakout for that piece. So, and then our last entity to talk about would be a C corporation. So like the pass-throughs, they can have multiple owners. It does have a separate business tax return. So that's Form 1120. But the different piece of this is that the tax is assessed and paid at the entity level. So if you're structured as a C corporation, none of the business activity impacts you as an owner, completely separate. So there is definitely some, appeal there if that makes you feel like some peace of mind that they're separate from your personal, nothing's going to be impacted on that side. And then there's no self-employment tax. The federal tax rate is a flat rate, so it's 21%. Michigan is 6%. And then if you're operating within city limits, you may have to pay some tax there. The Michigan return, just a side note, isn't required until your revenue goes over $350,000. So when you're first starting out, you may not need to file a Michigan return for your C corporation. So some of the downsides, unfortunately, a C corporation can't issue those tax-free distributions that we talked about for the pass-through entities or the single member LLC. So there's a couple options. You're working really hard, you got your entities, making a lot of money, and you like to be able to reap the benefits of that. There are a couple different things you can consider. One of them would be to pay the owners a dividend. So you could have the entity write a check basically to the owners, but that would be non-deductible to the business. So even though it's an outflow of cash, you don't get to reduce your profit at all by that. And then on top of that, it's taxable income to the owner on their personal return. So if they get a dividend check for $10,000, they're supposed to report that as income on their personal return and pay tax on it. So not ideal, not as friendly as like the distributions for the other entities. Another option would be to pay the owner's wages. So if they're actively involved, they want to get a paycheck every couple of weeks. And that may be deductible depending on whether they're involved with growing the actual plants, or if they're purely administrative, then it would probably not be deductible. So it's a little bit more of a complicated discussion to talk about that one. But again, there's a couple options there. But probably, again, one of the bigger perks, just probably the greatest separation between personal and business in terms of that, liability limiting bullet point we talked about. So the entity selection is pretty fairly flexible, which is nice. You know, if you start out as an LLC, it does not mean you're trapped as like a, you know, you're start out as like a single member. You want to bring in other people to be involved. There are different forms you can file to change your entity treatment. So it can, sometimes they're actually pretty smooth transitions. And sometimes if you're trying to go back from like a C Corp to something else, it can trigger some unwanted results. So definitely something to talk about with your CPA before you actually move forward with filing one of those forms, but some food for thought there. Some common tax filings. So we talked about the different business returns that you may file. I'll talk a little bit about 280E impact. That's probably one of the bigger things people tend to hear about with cannabis entities and taxes. A few other forms like Form 8300, sales and excise tax, personal property tax, payroll tax, and issuing 1099s to your independent contractors. So a lot of different taxes. It's not fun, but definitely all important stuff to be aware of. So the history of 280E, where this code section came about, was actually pretty interesting in my opinion. I'm sorry, I went ahead and I love movies. I was like pulling in some of my favorite movies in here, but the story is actually pretty interesting about how it came about. There was this drug dealer in the mid 70s, and he actually, you may not know this, but if you receive income illegally, you're actually supposed to report yourself or report that income on your tax return. And Jeffrey went ahead and he reported his income and his expenses and, you know, of his illegal operation. And of course, he was selected to be audited. And interestingly enough, they ended up upholding like all of his expenses, allowing them. So I just think it's interesting. You look at businesses with their cost of sales or inventory and things like that. So he actually would track, like he had a receipt for a scale, you know, like different mileage, meals and entertainment, stuff like that. So anyways, the court ended up, you know, allowing him to take the expenses, and people, you know, weren't really happy about that. And so they created this code section 280E, which is pretty short. And what it is essentially saying is no deduction or credit is allowed for any amount paid while operating like a business that consists of trafficking. And if the controlled substance is on Schedule 1 or 2, that's prohibited by federal law. Most businesses are allowed to deduct what's considered ordinary and necessary. So that could be mileage, marketing, accounting fees, legal fees, license fees, things like that. However, because this code section is so punitive, they disallow all of those expenses for cannabis entities. So unfortunately, we don't have like a black and white description of what is considered trafficking. What we've come to kind of understand it means is plant touching. So that would expand to like a cultivation facility, transporters, provisioning centers, the retail side of things, lab testing, processing of the plants, you know, those types of activities. It doesn't apply to hemp or the landlord. So it's pretty common for like a grower, retailer, processor, any of them to have their own building that they're doing all this activity in. And we would definitely recommend setting up the building in a separate LLC and then establishing like an arm's length lease agreement between the two. So as long as that's in place, we feel we could argue that the landlord side is not subject to that 280E punitive code section. There have been a lot of major court cases in different states where cannabis has been legal at the state level for a lot longer. And, you know, people get really creative. They try to create tons of different entities, and they feel like by doing that, they can kind of escape the reach of the 280E. But unfortunately, it seems to backfire. It seems to show that like if you're trying to move the shell around, that you actually may end up getting all of your expenses disallowed for all entities. So something to be careful of. Let me see here. So really quickly, the illustration of the punitive effect of 280E, you've got two businesses, one that's non-cannabis, one that's cannabis. They both have the same sales, about $1 million, same cost of sales. So that's their product, their allocated cost of product. However, the non-cannabis entity can deduct overhead, administrative type expenses. Like I said, marketing, accounting, legal, all these expenses that are necessary to operate as a business. However, cannabis, because of 280E, does not allow those expenses to be deducted. So you can see they're actually getting taxed effectively at a much higher rate. So it is tough. And that's one of the things we definitely talk to clients about is just cash flow management. Even though you're making a lot of money, the back end is it could result in a lot of tax if the, and you don't want that to be a surprise. So it's legal at the state level. And so that's another thing too to be careful of. So Michigan does allow you to take all of your ordinary and necessary business expenses. So you want to make sure for a C corporation, for example, that you're taking that expense. There's a specific line called Miscellaneous. If you look at the instructions, it's specifically for cannabis entities. So make sure you get that deduction. And then if you're a partnership or S Corp or another return that doesn't have a state filing at the business level, just make sure you get that subtraction at the personal level. Form 8300 hopefully will not be such a big deal, but because banking was so tough for a while, cash transactions were a lot more common, and major grow operations, that are selling large quantities of product and getting cash payments of $10,000 or more, they're technically supposed to file this Form 8300 within 2 weeks. And unfortunately, even if like an entity wants to be compliant, it can be tough because you're required to get the social security number of the person actually giving you the cash, even if they're just an employee of the business they're running the errand for. And of course, people are hesitant to give out their personal information. They don't, there's a lot of identity theft issues, and it just seems like that's a oversight of the way the form was designed. The penalties are huge. I'll go over that in the next slide. But like I said, looking at other states where cannabis has been legal a lot longer and the IRS started to audit, it seems that one of the areas they focus their efforts on is Form 8300 compliance, because it's easier for them to kind of test for that and see if those forms have been filed. And if not, they could potentially get a fair amount in penalties. So there are civil penalties and criminal penalties. Civil penalties, like I said, can be quite high. And it's just something, like I said, just to have on your radar, and hopefully we'll move closer towards the fact that a lot of this cash payment thing will go away and it'll be more like a transfer on a bank, the banking side. Sales tax applies to the end user only. So growers and processors are exempt from collection. The sales tax is 6%, like any other industry, and it applies to both medical and adult use licenses. And so there's a filing side of that, just making sure you file your tax return in time for that piece. Unlike the sales tax, which applies to both medical and adult use, the excise tax applies to adult use only. And so, combined with the sales tax, the adult use has a 16% rate of tax assessed at the end user level. So the retail center has a client come in or customer, they buy their product, then the 16% is calculated at that point, and then it needs to be remitted to the state. The state does have an online option. It's called Michigan Treasury Online to make those payments. So for grow or cultivation facilities, we would make the argument that they fall under the umbrella of this manufacturing exemption for personal property taxes. So again, another tax. And what it does is it essentially removes the local personal property tax and replaces it with a different tax at a lower rate. and what this tax is on are things that are considered personal property. So it'd be like furniture, computers, equipment, all that stuff that's underneath the umbrella of the company. Technically, like local jurisdictions can assess a tax on that, and it all varies and stuff like that. But just be aware that there's this exemption available to file, and those filings are due in February and August. Payroll tax is another big one. It seems like it's one of the easiest things to mess up. There are a lot of great payroll options out there. So, and they tend to make sure that all of these filings are done. So, and that's great, because if you miss one of them, it seems like it can be a bigger penalty. It can cause like a domino effect, unfortunately. So making sure like right out the gate, if you've got employees, that you get with a payroll processor that can make sure that you stay compliant with all of these different forms and remitting your payments on time, and just really remove that headache from yourself, so you don't need to worry about missing one of those deadlines. Let me see here. So the Form 1099 you would issue to like independent contractors. So those are not employees. Those are really people that are like providing services and kind of more of like a one-off type of thing. Like you think of like lawn care or plumbing or those types of services. So whenever the amount goes over $600 for the year, Form 1099 should be issued and given to the vendor. It is important, like on the front end, to get a W-9 from a vendor before they provide the services and get their check, because it is really tough to backtrack. The 1099s are due in January the following year. It's like to try to go back and get the information from somebody you haven't talked to in months can be really tough. So just getting that W-9 on the front end can be definitely helpful. Also, it can be great for your AUP reporting for the MRA, which we will talk about here next. So this is the last leg of the presentation. So as you may be aware, the MRA does require an annual financial statement. And so you will need to engage a CPA to complete this filing requirement on an annual basis. And it does apply per license. So if you have multiple licenses, whether you stacked grow licenses or you've got grow, processing, retail, vertical integration, you'll have a separate annual financial statement requirement for each one of those on an annual basis. Oh, so you may get a letter like this from the MRA, and unfortunately, there's no like one set deadline. Like all of these are due every October, for example. The deadline will 100% depend on when you received your approval of your license. So you should get a letter like this from the MRA, which states your deadline, which in this case is September 30th. And you'll get it for whether it's medical or adult use, one or the other. So the MRA says an annual financial statement, and what that really means is agreed upon procedures. So that's supposed to be like not as intensive as an audit, but unfortunately, if you're dealing with like a large number of transactions, or maybe your accounting wasn't set up right out of the gate, it can be kind of a pain to go back and try to get everything set up correctly. So like I mentioned, it's required for each license, and the MRA does have a template for both medical and adult use. And so what they're going to be doing is trying to tie out your revenue to your metric reports that they have. They're also going to look at your top vendors, so disbursements. And I don't mean to sound like it's picky, but it is tough because the MRA's got a lot to get through. So there can be sometimes a delay before you hear back from them, and they may have missed that you attached like an addendum explaining something, and they'll send kind of like it's kind of a scary letter to get a notice of deficiency or whatever, and it'll look like you're about to get your license yanked, but then you try to explain, you're like, oh no, we explained why this was, and it takes a long time to get that all sorted out. And and this is probably common sense, but best way is to prepare for the AUP, making sure your accounting's up to date. As soon as you get that letter from the MRA with your deadline, it's great to proactively find a CPA that'll make sure you're scheduled and prepped well for the AUP to be completed in advance of the MRA deadline. The MRA does not extend. They don't offer extensions. They do penalize. So it's something you want to make sure you're ahead of. Those templates are available online. So if you do want to go ahead and like look at the types of questions they ask, that's something that, or, you know, the way that things are structured, you can look at that ahead of time. And then if you're using something like QuickBooks for your vendors, if you take time to like include in the memo what the disbursement is for, that can definitely speed up the AUP testing, and hopefully keep the cost down somewhat. So just a couple tips there. And then one last plug for accounting. So importance of the bookkeeping. It's very common for us to see folks start out using QuickBooks right out the gate. It's low expense. It definitely can do the job. And sometimes though, when people ramp up to a certain level or have multiple locations, it makes sense to upgrade to something like Intact. They have some really cool dashboards that will show like what the highest line product is at this location, at this location. So it can definitely help you make decisions more quickly, but it's very expensive. It's an investment. So something to look at down the line. And then bookkeeping, you're required to keep your books on GAAP, which is generally accepted accounting principles. And cost accounting is extremely important. So like when I mentioned earlier about the 280E being punitive, we want to make sure we allocate all appropriate expenses to the cost of sales, which is allowed as a deduction. So that's something, you know, especially in the front end, if you can get ahead of it, that helps you. So I guess I listened to a podcast on periodic effects a couple years ago, and I still think it was a great one. The interviewer was speaking with Andrew Brisboe, who's the executive director of the MRA, just about like, you know, the MRA's plans for oversight of the state of Michigan, how it compares to other states, you know, the kind of plans long-term and stuff like that. So I thought it was pretty informative, and I definitely would recommend listening to that. But that's all I had. So are there any questions?
We do have some questions here that came in, and it says, how does consumption lounges fit in with the tax laws?
Consumption lounges. Okay, so would that be a situation where they would be buying them and smoking them in the same place, or would it really just be like they would buy it at a different location and go to this location to smoke it?
My understanding was that they buy it from a different location and come to smoke it.
Right. That's a great question. I guess I would assume that, yeah, I would need to check on that. I guess if that person wants to reach out to me separately, I'd be happy to look into it a little bit more. So far, we've really just operated on like the grow, processor, retailer, you know, lab testing, stuff like that. Not so much on like the ancillary stuff. Yeah, that's a great question.
Yep, and we had someone join late and just wanted to know who was the speaker of the hour.
Oh, sure. I'm Maddie. So I'm a CPA, so I'd be happy to share any resources or anything like that.
Okay, great.
I have a question. Sure. I know you shared a lot about, you know, the possible mistake of mixing, you know, personal and business, you know, finances. I guess, are there any other things that you see or tips and tricks for, you know, those of us who are operating in a small space? Perhaps, you know, we've worked on other small business projects where we've perhaps utilized QuickBooks or even just Excel spreadsheets when we're trying to manage it ourselves. I guess it's a twofold question. One, are there any tips that you recommend for someone in that space? And I guess at what point do you recommend handing it over to a professional?
Sure. No, that's a great question. I love QuickBooks. I mean, I feel like it's very effective and the cost is quite low. And I know some other firms are like this as well, where they can just do little like a 1 hour kind of consulting thing on the front end on setting up your QuickBooks. And I think that's kind of, I would say that would be a huge tip, is just to take the time to set up your accounts properly on the front end. And that way you're not trying to, like, at the end of the year, you have $600,000 or $100,000 in expenses and you're trying to, put everything in the right bucket. So I would say doing that on the front end. And again, other firms too are like, they'll kind of scale things. So if you want somebody to check your books, like I said, for an hour or something a month, just to make sure things look right. But I think like that, for a smaller kind of entity, that totally makes sense to start out. I would say once you get to the point where you might be stressed about like your taxes or things like that, or how much you may owe, sometimes all we need is like people to send in like their profit loss statement for the year to date. We can kind of project what their tax is, so they can start setting aside enough cash to make sure they pay their tax, because that's a big one. Nobody likes to suddenly be surprised by the cash due. So I think that's on the other end of things, is as you're getting your entity going, is kind of keeping in the back of your mind how much cash you may need to actually pay the government on the back end.
Is there anything else?
Let me see here. If anybody wanted to reach out to you, Maddie, what would be a good email to have down?
Oh, sure. I think it's, I don't know, should I just chat it in? It's mhenry@Maynard CPA.
Okay. Okay. Yep. Thank you very much.
Sure.
And I think that concludes. I don't see any more questions.
Okay.
Are you all set, Tatiana?
Yes, I am.
Okay. Well, thank you everybody for joining. This video will be uploaded to our YouTube page as a reference. If you search MICIA Canacast, and if you have any questions, please let us know in our messages. And I hope you have a great day, everybody.